strategist at Morningstar, for a conversation on this and other topics as well. David, thanks a lot for joining us. This is a very out of consensus call. It's difficult to find anybody these days who's not bullish on gold. I wondered if I was looking at a typo when I looked at my notes in preparation for this interview. Your target price on gold and that of your colleagues as well, $1,820 US per ounce. Talk to us about it.
Sure. So that is our published forecast right now from our equity research team. And it's really based on a combination of their supply and demand analysis over the longer term and taking into consideration their estimates for extraction costs over the next 5 years as well. And when we look at gold, it certainly has had an incredible momentum rally over the past year. But when I'm looking at what's going on in the market, those factors that historically result in higher gold prices are certainly starting to wane in my view. So if I look at real interest rates, that's always been a big predictor of gold prices. Those are positive here in the U.S. And in fact, we expect that real interest rates probably become even more positive over the course of the next year. We do expect that inflation will moderate here in the U.S., getting down to the Fed's target, by the end of this year and moving into next year. And of course, the old adage in the commodities markets, the cure for high prices is high prices. So in this case, over time, we would expect to see demand destruction for gold. I think you always have to remember with gold, well over half their production is used for jewelry. So we'd expect to see some substitution effect there over the next couple of years. And then another, 10 or 15% of gold is used for industrial use cases. So again, we'd expect to see some substitution away from gold for those use cases. And then lastly, we'll also see additional supply coming online. Now, granted, it does take a couple of years for additional supply to come online. It takes at least a couple of years to be able to start building out additional reserves. But again, those high-cost gold reserves right now that are not being mined, will become more economic at $3,000 an ounce. We think that energy prices are coming down, so that will bring down the costs of mining a lot of those types of reserves as well. And then lastly, you have to look at what's going on here in the U.S. You've got President Trump and Elon Musk with his Department of Government Efficiency really cutting as much government spending as they can. I know the goal there, quite ambitious, but they're looking for cutting $1 trillion of spending in the U.S. So I think all of those factors, and again, it may take the next several years for those to work through, but that does really predicate our long-term gold price forecast. So again, not this year, not next year, but over the next 4 to 5 years, that's our published expectation for it to come down.
One thing I don't believe you touched on was the U.S. dollar. There's a fairly tight inverse correlation between gold and the U.S. dollar. When one goes up, the other tends to go down. We have seen over the year so far in 2025 significant, and we're looking at it now on our screen, the Bloomberg U.S. dollar spot index, significant downward pressure on the greenback. Does this, do you factor the U.S. dollar into your call?
We do, but I think you also have to be, very cautious in how you're trying to forecast, the U.S. dollar here in the short term. Certainly, a lot of that is going to play out with, the ongoing tariff negotiations that President Trump is in, with not only, Canada and Mexico, but I expect that once we're done with those negotiations, he probably targets the EU next. So I think we're going to have to live with a lot of volatility in the U.S. dollar, over the near term. Longer term, we are looking for the U.S. dollar to strengthen over the next couple of years. So again, I'm very cautious about trying to predicate what's going to happen in gold, in the shorter term based on the dollar, and really keeping to those factors that we think influence gold, over the longer term. Now, it's not to say that every miner is overvalued at this point. In fact, at the beginning of 2024, a lot of the gold miners were 4- and 5-star rated stocks. We thought they were very attractive. After the run they've gone through, a lot of them have moved into overvalued territory. Two that we still think are attractive today. So if you're interested in gold, I'd highlight Barrick Gold as a 4-star rated stock. Our fair value estimate there is $22 a share. And then the other one is going to be Newmont Mining. That's a $51 fair value estimate there. So again, both of these companies have had some idiosyncratic issues here, in the short term, but those are still two stocks that we find attractive today.
David Sekera, thanks a lot for your take on gold. We'll be back with David Sekera for a second conversation.